Hello, I'm Brian Spinelli, Chairman of the Investment Committee at Halbert Hargrove and Senior Wealth Advisor. Today we're going to be talking about our Q1 2018 market insights. The three main components are definitions around market crashes, corrections, and bear markets. Since 2017 was such a calm year and 2018 has now started off to be a more normal, volatile year, we thought it would be timely to discuss these three areas and define these terms commonly used in the media. So let's define a correction first. A correction is a short-lived 10% or more decline in a market, generally followed by a rebound in prices. Now let's define a bear market. A bear market is different from a correction. A bear market is generally a 20% decline, and the definition can vary with time. Usually a bear market is followed by a long period of pessimism, and it generally will prolong itself over multiple months and not be as short-lived as a correction. Lastly, let's define a crash. It's a common term thrown around in media headlines. A crash is generally a short-lived, very significant decline in markets. What makes it different from a correction is it's usually a lot larger than a 10% decline, and it's generally over an extremely short period. So think of 1987 where the market dropped 20% in a single day. That would be an example of a crash. So let's talk a little bit about what's normal for markets. In this picture of the S&P 500 index, which measures the 500 largest US companies that are publicly traded, we went back over 38 years to show you what has happened in markets. What you see in the attached is in the big dark gray bars are the returns by calendar year. That's where the index finished up for the year. So if it was above the line, it's positive for the year. If it's below the line, it's negative for the year. And in this picture, we also overlaid some other data. In the red dots, you will see what the largest decline over that calendar year was. And what you will notice is that on average, there's at least one 10% correction for every single year. And I say that on average. 2017, we did not see any sort of corrections to that magnitude. And in fact, buried in this data, which you cannot see on this slide, is it's normal to have about 5% corrections in each calendar year. So what you see is that while there are significant declines over each calendar year, markets generally finish positive. In 29 of the last 38 years, the market has finished positive despite the intra-year volatility that we've experienced. While 2018 is off to a bumpy start compared to 2017, we thought it would be timely to show this and have a discussion around what exactly is normal in markets. And 2018 seems to be more of a normal year versus what we experienced last year. We hope you enjoyed this quarterly insight, and we look forward to speaking with you.